Hey everyone, it's Paul with the Bold Profits for this Tuesday. I've made a video last week talking about the rules of the game, which is a way of operating, if you will, in the stock market. Now, many people have no plan, no sort of sense of how they are going to use the stock market. And as a result, they are often doing the wrong things or doing the wrong things, even worse, at the wrong time, or even in some cases unaware of actually what kind of, they call it an operation. Like if you read some of the old books, I've got some of these old books up here that actually go back to the beginnings of the stock market. People who traded the markets were called stock market operators. At least the good ones used to be called stock market operators. And in a way, that term really does mean something even today. In other words, the stock market is a little bit of like a machine, if you will, a kind of something where you do need to understand what operation that you are trying to do, enact, execute, if you will, on this machine. And for me, there are three different kinds of operations, if you will, that you would look to do in a stock market. Now, the most common one, and the one that you are going to read most about in terms of on the internet, whether it be on the big websites, MarketWatch, Yahoo Finance, etc., at least what they claim to be is investing. And so let's just lay out what investing is, at least in the way that I understand it, based on my experience of having been on Wall Street for nearly 20 years or so, having managed large $100 million plus mutual funds, billion-dollar mutual funds, and hedge funds, private accounts for some really big folks who I cannot name because of various agreements that I've signed. Nonetheless, I can tell you that investing means something like what people talk about in terms of Warren Buffett and people like that. In other words, you buy stock in a company and then you wait for the company's value to rise because of the business that it is in. And as that business grows its sales, increases its profits, there is an assumption that people in the outside world that represent the larger investment base will come and buy the stock. And because it is now rising in terms of its value, in terms of its worth, that can be measured in some way by its accounts, by its income statement, by its statement of cash flows, by its balance sheet, now its price will rise as a result of people coming to buy it. And so a good example of this might be a stock like Coca-Cola, which Warren Buffett very famously bought very cheap. Coca-Cola, over time, people began to realize had this drink that everybody around the world wanted to drink. Its sales rose over time, its profits rose over time, and its stock price rose alongside with it. And that, in a way, is a very simple way of understanding an investment. It's where you buy shares in a company, stock in a company, whose rise is going to, in some ways, be accompanied by a rise in the value of its business as measured by something that you can see on its various accounting statements. And this is what a lot of people write about, talk about, tell you about. In other words, you're buying shares in a business. As the business's value rises, the share price is supposed to rise. Now, there are definitely some issues with this kind of investing. In other words, sometimes you can definitely see where the stock price can run well ahead of the company's growth. And sometimes as the company grows, you may see the stock price go down. Or sometimes you may see the business continue to grow and the stock may do nothing at all. And sometimes you may actually see a case where a company is actually seeing lots of negative things happen. However, because the stock market is anticipatory, and I know it's a big word, anticipatory. In other words, it anticipates what the future is going to be. Because people anticipated a much worse outcome, you can actually see the stock rising. So this investment way of going through the stock market, I have found in my experience, is incomplete. It can be for some number of people and in some kinds of stock markets, which is, again, the subject of another video, different kind of stock markets. This way of investing can sometimes actually be something where you feel you are doing all the right things. You've bought a company where you can see its sales and its profits are rising. You can go through analysis of the income statement and statement of cash flows and balance sheet and all of these things. And still you are seeing either the stock decline, the stock stay stagnant, you're making no money. And so investing by itself can sometimes be problematic, can be sometimes frustrating, and can lead you sometimes to even lose large amounts of money because of what I mentioned. In other words, if all of the good things that you think are going on based on your understanding of the company and its various financial statements are already anticipated by the stock market, sometimes into good news, you can actually see your stock go down. So investing in this way, for me, is somewhat problematic depending on the particular context or situation or scenario that you are picking. So hopefully I've explained it enough that you still understand what investing, at least mentally, what is supposed to be. In other words, it's supposed to be where you buy stock and the company's doing well, you expect the stock to continue to go up alongside with how the company is doing in terms of its financial statements that it publishes. All right, so I'm going to skip the one in the middle, which is speculation, and now go to what it means to be a trader. Because this is the other thing that is widely written about, and it is essentially a kind of thing where largely the people trade based on price movements alone. And by price movements alone, I mean that people buy something for $1 and based on some kind of quite simplistic analysis, usually based on charts. You can go onto Yahoo Finance, MarketWatch, bar charts. There are hundreds and hundreds of websites that will give you charts that allow you to put various things like a moving average. There's various different kinds of indicators, hundreds and hundreds of indicators. Everyone claims that some indicator works. Personally, my experience is that pure chart-based analysis has largely very little actual meaning and gives you almost no advantage at all in terms of actual trading. And that's because largely if you look at what the daily movements of prices are, which is what people who are traders, people who call themselves day traders, which I would call liquidity traders. In other words, what you are really doing when you are trading, let's say you are only buying and selling something like Tesla every day. What you are doing is you are either providing liquidity to the stock market. In other words, when someone wants to sell, you are willing to buy because you think that you can sell it for a higher price later on. Or else, if someone is willing to buy, you are also willing to sell because you think that you can buy the stock back at a lower price at some point in the future. So I know this may be a little confusing, so I'm just going to explain this one more time, or at least repeat it one more time. In other words, if you are a trader, what you are in the business of doing is either providing liquidity or taking liquidity. In other words, if someone is looking to sell, you are willing to hand your cash over to them in exchange for their stock. And the only reason why you would do that is because you think that you can sell it for a higher price some period later. It may be 1 minute later, it could be a second later, it could be hours later, maybe it could be a day or two later. However, generally anybody who calls themselves a trader generally has a very short time frame. I would say for the vast majority of people, it is maximum of something like 5 days, 1 week. They might begin their trading operations on Monday morning and they would largely end it by the time the stock market closes on Friday. And I would say that many people have much shorter time frames than that even, which is that it might be just for a day or 2 days. And once again, you're either providing liquidity or taking liquidity. So as I mentioned, in other words, if somebody is looking to sell, you give them cash, take shares. If somebody is looking to buy, you give them shares and take cash. And that is what a trader is doing. Now, many people may lack the understanding of what they are doing, because I know many people refer to themselves as day traders and talk about trading. However, many of them seem to lack the understanding of what exactly they're doing. In other words, when they buy shares, they are providing cash to somebody. And many traders, especially new traders, never really take the other side. In other words, they are never willing to actually sell short. In other words, where they are taking cash and providing stock. And that requires doing something called selling short. And that in many ways, really, for me, really marks somebody that understands trading. In other words, they understand when short-term prices might be too high based on a true understanding of either the stock market or the particular stock that they are trading, and they are willing to go the other way. Whereas most new traders really only take one side. They buy a stock and they expect it to go higher and sell, whereas more experienced traders go both ways. They are both willing to buy and sell, both give liquidity and take liquidity at various prices. So hopefully that was not too confusing, and you understand the difference, at least between an investment and an investor and investing, and a trader and trading. The traders are largely providing or taking liquidity. Now, there is a third category, which is the category that I fall into, and that all of the services at Bull Profits, which is my publisher, publishes. And we have a number of different newsletters, and we take the middle position. We are what we call position speculators. In other words, we are willing to buy, and we do depend on a price rise as well to make money. And that price rise can be for a number of reasons. It can be like for an investor where it may be come about as a result of a lift or a rise in the company's business prospects. It can be also because there is a temporary imbalance that might run for any number of days, might be for a number of weeks, where there is so much demand for the stock that it keeps getting bid up to rising prices. And so being a speculator means you incorporate both sides. You're a kind of investor and you're a kind of trader, and you're somewhere in the middle. And as an investor, your time frames are usually very long. I would say minimum 5 to 7 years, 10 years. Warren Buffett very famously talked about his time frame being forever. And traders, as I mentioned, usually have very, very short time frames. It can be as little as a second or a minute. And certainly there's many traders just have one day. And I would say the vast majority of traders, maximum they're in any stock is 1 week, five business days. Now, as a position speculator, we are generally in for stocks for 1 to 3 years. And so our time frames are shorter than a pure investor, somebody that's doing pure investing, and definitively significantly longer than somebody that's purely trading. And we seek to benefit ultimately from what we call a demand and supply imbalance. And a demand and supply imbalance can be as a result of a number of things. It can be because the stock market lacks at this point the understanding that a business is going to see rising value, and so you buy stock ahead of it, and as the stock market comes to your view, they come to buy it, and in the process they bid it up. It can also be where the stock market has anticipated a future that is so bad and so terrible that when that future is less bad, less terrible, there is demand for the stock that also causes to be bid up. And there are any number of scenarios like that that a speculator looks to take advantage of. Now, as a speculator, we only do one thing, although there may be speculators that go, if you want, say, both ways, where they're willing to sell short. In other words, bet on a stock going down in anticipation of buying it cheaper later. However, in our services, we only go long. In other words, we only buy anticipating a rise in the future. And you can be a two-way speculator. However, just like with trading and just like with investing, we only go one way. We buy. We look for a price rise based on a demand and supply imbalance, which can be based, as I mentioned, on a number of different things. Ultimately, it is based on something where we expect the demand for the stock to continue to keep rising, usually because there's a rising value to the company, which, as the kind of speculators that we are, we look for rising sales growth. And that is what, in my experience, is the thing that really drives big gains. So that's one condition. We want the stock to be scarce, both in of itself in terms of the amount of stock that a company has issued and relative to other companies that do the same thing in the stock market. And third, we want the stock to show that it is in demand. And a stock shows that it is in demand by the fact that people are coming to bid it higher on a regular basis. It may be daily, it might be weekly, it might be over some number of months, it can be over some number of years. So those are the three types of operations, three types of sort of investment personalities that you have to decide to take on if you want to enter the stock market and try to actually make money, instead of really gift a lot of your money to market makers, who are the people that do a lot of the short-term trading, hedge funds, which are very sophisticated ways of understanding investing, speculating, day trading for sure. They have access to unlimited amounts of money. They can borrow at very low rates. So they have enormous advantages over the vast majority of people. And for sure, the most competitive area in investing is day trading. And there, the vast majority of people have no advantage. And the other side, whether it be market makers, these are people that buy and sell daily. Generally speaking, when you are completing a trade, there is some intermediary, some middleman, if you will, middle person, if you will, that is actually fulfilling that trade. And they take on that position in the hopes of being able to make money. In other words, whatever they sell you the stock for, they're hoping to make money on top of that, either to sell it higher if they're buying from you, or if you are buying from them, to be able to buy it back cheaper. And in terms of investing, there are a lot of people that obviously do investing. There's people like Warren Buffett. There are other people that do that make investments based on the long-term value of a business. However, the speculation side is a little bit more thinly trodden. And this is where Bull Profits and our publications, where we look to make money by looking at the demand and supply imbalance relative to those three critical factors. Now, three other critical factors in this system, which I have coined as called my going upness system. And I came up with that name because ultimately, as a speculator, the only benefit you get from being, whether it be in a stock or any investment as a speculator, is from its price rising. And that is the benefit that we desire, that we are looking for, that we are looking to get. So hopefully I have been able to define for you the three sort of investment personalities, three operations that people look to do in the stock market. And if you have additional questions, put it down below and I can make a follow-up video and try to answer any additional questions that people have about the differences between the three or various elements of the three. However, understand that in terms of our services, we are speculators. We look to put positions on for between 1 to 3 years. And if the speculation is successful and it's going to see a continued support, and support means that the stock is going to be bid higher, then we will stay in it for even 5 and 7 years. And for instance, in my Profits Unlimited service, which is my flagship service, has a lot of subscribers in it, we still have original position. Position number 1 is still in our portfolio. It's up over 400%. It's looking set to go to make new highs. And so if you're interested in that, well, just click on the strong hands above. That's going to take you to my latest presentation on America 2.0, which in many ways refers to the ultimate demand and supply imbalance that I've seen, certainly in my career and in my opinion, over the last 100 years. This is the most extreme demand supply imbalance you're ever likely to see. So enormous opportunity. If you want to check into that, click on the strong hands above, and I'll have another video for you next week. If you like the content on this channel, please give this video a thumbs up, subscribe to the channel, click on the bell so you get a notification when we post a new one. Until next week, this is Paul saying bye.